And now let's do a preview for the non-farm payrolls. So non-farm payrolls is always important, as you know, most important event on the economic calendar. Well, that's historically been that way. And this time it's even more important. So if you were fading this event in previous months, this time it's more important because of Jackson Hole. Janet Yellen said that the case for rate hike has strengthened, but she said it's data dependent. So if we take her words at face value, that means that this non-farm payrolls report is important. Markets are still skeptical of a September rate hike. Let's show you the rate hike odds here. So this is the CME Group's FedWatch tool. According to bond markets, only 24% chance of rate hike. Not that optimistic in September. For November, a week before the elections, more or less the same. After the elections in December, we already have a real chance, 55% of a rate hike. I think those bond market expectations are correct because I don't think the Fed will raise rates before the elections. Remember, Hillary Clinton is the incumbent, going sort of for a third term of Barack Obama, and raising rates now will sort of hurt her chances, and she will not like it. Same thing for Donald Trump. Well, not same thing, but he also always said he's a low interest rate guy. And also, the Fed does not want attention, not from Clinton and not from Trump. I don't see them wanting to draw attention before the elections. I see them as sort of looking for an excuse not to raise rates. Okay, so in my opinion, we'll need a very, very strong NFP report to justify a rate hike. The Fed in general is just dovish. Okay, so even if they move a bit more to the hawkish side, they look for an excuse not to raise rates. Let's look a bit at the expected figures. Two things to watch: the headline figure, non-farm payrolls, and of course wages. Wages at some point early in the year were more important than the headline figure, but after a few months, April and May were weak in terms of job gains, so we refocused on the headline figure. Now we had a strong June, 292,000 according to the revised figure, and also a strong July, 255,000, above the average of around 180 to 200,000. So the focus is back on the headline. I would say maybe they're equal, more or less. Okay, so now we're expecting more, not like last time, but more in the general trend, 186,000. Let's see if we have adjusted expectations following the ADP figure and the ISM manufacturing PMI, and wages 0.2 as expected, which is sort of average. Last time it was above average, 0.3 month over month. I think we better look at the year over year. Last time it stood on 2.6% year over year. We already reached 2.7. I would say we would need, they're equally important. Another thing to watch out for is the average work week. Usually it's very stable at 34.4. Last time it went up to 34.5. So let's see if it goes back down to the normal levels or not. If it stands out, with the big jump, it could add some impact. Usually it's not a figure we watch out for. The unemployment rate, more important for politics, less important for markets, because we know that any change in the unemployment rate is a result of also a change in the participation rate. So if we have a drop in the unemployment rate, but also a drop in the participation rate, it doesn't mean that much. If we have a drop in the unemployment rate with a rise in the participation rate, of course, it's all good stuff all around. What numbers would we need in order to raise the chances for a rate hike? I would say another jobs report of 250,000. Again, another blockbuster report, a third consecutive month of 250 plus. Of course, no big downwards revisions. And we would need wages to break to another high. That means from 2.6% year over year last time to break above the 2.7% high, cycle high, to reach 2.8%. So if we have 2.8% and above 250,000, I think that there will be much higher speculation for a rate hike. That means that despite the elections, despite the dovish Fed, the data will just be too good for the Fed to ignore it, okay? Of course, there are more figures like retail sales, and we could have any kind of global slowdown, Chinese stock market crash, you name it. Remember, we have 3 more weeks until the Fed decision on September 22nd. But again, to raise the chances significantly, we need good figures. If we have just an average report, which is good, not bad for the economy, but nothing to rock the boat, I think the Fed will find excuses not to raise rates. That means I think the 200,000 and 2.5% year-over-year wage rises, which is okay, will not be good enough for the Fed to raise rates, okay? And not be good enough, that means for the dollar to continue higher. So we would need a good report to keep the momentum for the US dollar. Momentum of the US dollar maybe will not last that long. And if we have, of course, weaker than expected 150,000 or lower, we could see fall, okay?